Before we begin, please support the channel by subscribing, liking, and sharing this explainer. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Today, we're diving into the Q3 market review, AI CapEx history, and technical stock updates.
As always, this explainer provides a direct, informational breakdown of our source material, so we can translate the latest data into some truly actionable insights for you. So this explainer presents a direct informational narration of the source document. Let's just jump right into it. Here is our roadmap for today. We'll start with a market and NFP review, look at AI versus historical CapEx, then we'll get into the technicals with a UNH stock update, a shop technical analysis, S&O breakout targets, and finally, the NVIDIA trajectory and outlook. All right, Section 1, Market and NFP Review. So while the broader market actually saw some recent gains on shrinking volume, that non-farm payroll report, it served as a primary and unexpectedly weak driver. Just look at these specific misses from the July data. Total jobs were expected to be a positive 80,000, right? But they actually plunged to a negative 23,000. And on top of that, we saw a massive 103,000 two-month downward revision. The private sector only managed to add 30,000 jobs, totally missing the 78,000 expectation. Plus, the unemployment rate came in at 4.1% against the expected 4.2%, and year-over-year wage growth fell to 3.2%, missing the 3.5 mark. Ultimately, these pretty stark misses have shifted September rate cut probabilities down to a range of about 40 to 44%.
Moving right along, let's get into Section 2, AI versus historical CapEx.
To really gauge the broader impact on GDP right now, it helps to compare this current AI data center investment wave to the 2000 telecom boom and the 2005 housing bubble. And wow, the projected scale of hyperscaler capital expenditures is just massive. We're talking about it reaching 3.1% of GDP by 2027. To put that into perspective, that sits literally right between the historical peaks of the telecom boom at 1.2% and the housing bubble at 6.6%. But here's the absolutely crucial takeaway, the sheer velocity of this trend. The speed of AI investment growth is nearly double the absolute fastest phase of the housing boom. AI capital expenditures are rising 1.7 percentage points in just 2 years. That translates to a growth of 0.85% per year, which heavily outpaces housing 0.5% and telecom 0.15% annual growth speeds. It's moving like wildfire. And this brings us to a significant caution that you really need to be aware of. If AI capital expenditures face a rapid pullback by 2028 and they don't have the matching revenue to back it up, it risks severe market corrections. For some context, this potential risk horizon directly mirrors the massive 44% drop we saw in the S&P by 2002 and that painful 38% drop in 2008. Okay, let's shift gears to individual equities in Section 3, UNH stock update. So United Health Group, or UNH, recently hit a high of 461, and it's now in this sort of slow decline. Basically, it just needs some time to consolidate. The stock requires time for natural valuation increases to kick in. Specifically, if we see a 10% lift in its 2028 forward valuation, that could push the long-term target up to approximately 540.
Next up is Section 4, Shop Technical Analysis. Evaluating Shopify, or SHOP, the analysis points out that it remains overvalued at a 60 times growth multiple, giving it a 2027 upper valuation bound of 135. Now, to break that 158 major resistance level, it's really going to require a strong gap up. Meanwhile, its key support zone is holding firm right between 123 and 128.
All right, let's check out Section 5, SNO breakout targets. Snowflake, or SNOW, just recently enjoyed a really successful gap-up breakout. By opening strong at 121 with some high volume, this movement signaled a totally valid breakout above that critical 120 threshold.
So you might be wondering, what exactly are the upward target zones here? Well, the process involves 3 pretty distinct steps. First, it has to clear minor resistance between 125 and 140. Step 2 is breaking major resistance, which sits between 147 and 159. And finally, Step 3 is reaching the full structural target of 180 to 193. Just keep in mind, getting to that final band requires a full structural move, and we'd need to see at least a 20% increase in fundamental earnings.
And finally, we turn to Section 6, NVDA trajectory and outlook.
Looking at NVIDIA, the technical indicators are remaining perfectly intact. Both weekly and monthly charts are showing completely normal positive trends, even despite a few daily overbought signals. A breakout above 216 sets a new structural target above 236, and notably, we actually want to see a slow, steady climb here. It's much preferable to those rapid spikes, mainly to avoid any severe pullbacks down the road.
There's also a really specific dynamic playing out in the Nasdaq right now. Basically, short sellers are getting trapped by this slow climb, and they're being forced to cover. This is helping to maintain a pre-high trajectory, assuming, of course, that the critical downside support at 693 holds strong.
And as it stands today, the Nasdaq is literally only about 3.5 points away from its previous high of 747. But when we step back and look at the broader picture we've painted today, everything from the slowing employment data to the absolute hypervelocity of AI capex we talked about, the ultimate question is this: if these technical breakouts stall, will the market have the fundamental earnings to catch it before we see a 2008-style correction? Thanks so much for tuning into this explainer, and be sure to let us know what you think in the comments below.